Thank you for having me today. I'm really excited to be here. Mike mentioned the guide to the markets. We put that out every quarter and actually update it every day. And it's essentially a 65-page chart book, purely charts, no commentary, no products, nothing. It is equities, bonds, how to invest, alternative investments, the US economy, the international economy. And every quarter when we're putting our heads together as a team and saying, okay, what types of things are going to go in the guide this quarter? What themes do we want to get across? We have that discussion, and this time around, one of the main themes we wanted to get across is acknowledging the fact that with the Federal Reserve raising interest rates as rapidly as it is, with the economy slowing down, it is very possible, and in fact probable at this point, that we could go into an economic recession, perhaps later this year, probably sometime next year. So we want to acknowledge the risk of recession. But we also want to acknowledge the fact that we've had a really challenging year in the markets already. And economic cycles and market cycles do not always tightly align. And what I mean by that is markets are forward-looking indicators. So by the time we get to the worst of the economic pain, what we have typically seen in the past is that markets have already bottomed and started to turn around. And we think that could very well be the case this time around. We're not quite at the worst of our economic pain, and yet we've probably seen most, but not all, of the pain within the markets. So two important things to keep in mind as investors, because I think in times like this, we get rattled, we want to do something with our portfolio, we want to make a change, and yet one of the best strategies in this type of environment is to be disciplined and be confident in the plan that you had initially set out, because the investment plans are meant to take into account periods like this. You know, we never know when or why volatility is going to come, but we know at some point it will come, and therefore we do build portfolios around that. So let's think a little bit about what we might see in the economy. So disclaimers, very, very important in this business. Let's think about the US economy. So what we can see on the left-hand chart is a line chart that looks at the total economic output in real terms of the US economy over time. And you can see that deep V towards the end of the chart, where we had a very strong loss in economic output during the early days of the pandemic. But then when things opened back up, we had a very strong expansion. You can see that V shape there. And actually, if you compare it to the earlier part of the chart where we see that like small little hill, that small little hill was actually the financial crisis, and we had less of a loss in output, but it was a very slow expansion after. It took a long time to recover. That was very different this time around. What you'll also notice towards the end of that gray line is that there's a little bit of a dip, that we started to slow down. And what you might notice in that chart of annotations in those that top line there, that second middle line towards the end, is that we had 2 quarters where economic growth was negative. And typically people say, okay, 2 negative quarters of GDP, that must mean we're in recession. But that's actually not the true definition of a recession. The true definition of a recession is that we see a significant decline in economic activity. And I'll talk a little bit about what are some of the measures that we look at to determine whether that is the case. But I also want to caveat, what do these 2 negative quarters mean then? Because that was a decline in growth. What pushed that into negative territory? Well, a couple of things that don't actually tell us a lot about the health of the economy. So 1, we imported a massive amount of goods in the first half of the year. That's because our consumer's been strong. People still want to buy. Things are cheaper abroad right now because the dollar is so high. So that's not necessarily a bad thing. We also saw inventories growing at a slower pace. That actually slows down that GDP number. And finally, we saw the fact that in 2020, in 2021, the government spent a lot of money, and that really supported growth. In fact, last year we grew at triple the pace we normally grow at, fueled by a lot of that economic stimulus, that fiscal stimulus. This year that we're seeing less of it, that's actually serving as a drag on growth. So none of this stuff actually tells you that much about the health of the economy, because if you take a look at the chart on the right, the economy is mostly consumption. 70% of our economy is driven by consumption. So when we think how good or bad is the economy, what we really want to be paying attention to is how strong or weak is the consumer. Now, consumers have fared through COVID remarkably well. You know, one of the things that my boss always talks about is the remarkable resilience of the consumer. No matter what is happening, you know, what terrible things are happening in the world, you can always rely on Americans to spend. Like retail therapy is probably one of our best coping strategies, and that is what we saw during the pandemic. Last year was the year of buy everything. Buy goods, buy services, anything that you could. This year, we're starting to see, as prices have moved higher, consumers are changing their behavior a little bit. So if you bought your gardening supplies and your games and your clothes, your furniture, your exercise equipment, everything that kind of got you through those early parts of the pandemic, right now you don't need new ones. So instead you're like, I want to go out on a vacation. I want to go out to a restaurant. So people have shifted their spending away from goods more towards services. But as prices continue to increase, we're probably going to see the consumer go through this third phase where they're spending just a little bit less overall, because everything incrementally is more expensive. Your essentials are more expensive, whether it's your gas or your food. So some of that spending is reined in. So we're definitely seeing a slower consumer, but it has been remarkably resilient overall. So that's one of the reasons why we don't think we're in a recession yet. I mentioned that there's a couple of different factors we look at to decide, okay, are we in a recession? Are we seeing this dramatic decline in economic activity? And what we've seen so far is that we've seen a slowing, but not an outright decline. So what you can see on the top chart is those different factors that we do look at. We look at jobs. We look at retail sales. So are people buying and spending? We look at industrial production. You know, are we continuing to manufacture and produce? We look at income. We look at spending. So we've taken a look at this heat map here of all of the different areas that we would tend to keep track of. And the heat map is essentially, you know, works like a lawn. If you're green, that's good. Your lawn is healthy. If you're yellow, things are starting to die off a little bit. We need to have take care of it a little better. And if it's red, then I don't necessarily know where you live, but that's a bad sign. So that's the same with the economy. And you can see across the board here, if you look at August, the most recent month we have data for, it's mostly yellow. In the jobs area, it's still lightly green because jobs have been very resilient in this market, but it's mostly yellow. So we're definitely slowing, but when it comes to recession, we're not there yet. If you look at the bottom chart, same set of indicators, you can see here that most of them have continued to grow over the last 6 months. Slower pace of growth certainly than we saw last year, but still somewhat intact. So putting all this together, that's why we don't think that we are in a recession yet. However, the Federal Reserve, our central bank, continues to raise rates really aggressively in order to tame inflation. And so eventually we do think that that will also push us into recession. Because essentially, when the Federal Reserve raises rates, it becomes more expensive for consumers to borrow. It becomes more expensive for businesses to borrow. It actually takes some of that demand out of the economy and therefore helps to bring prices down. But it's as if the Fed is intentionally slowing down the economy. The challenge is, it's hard to Goldilocks the situation where you can slow it down just enough without necessarily pushing it into recession. So at this point, we think potentially recession next year. We have to continue to monitor the data, but as such, we've been remarkably resilient thus far. Now, we hear the R word, we hear recession, and that inspires a lot of fear and a lot of hand-wringing because the last 2 recessions we experienced were incredibly severe. So I think it's important to characterize, okay, fine, maybe we see a recession on the horizon, important to be realistic and important to acknowledge that, but what might it actually be like? Because we think that this next recession could actually be a lot milder than the last 2 that we faced. So just to put recessions into context, if you take a look at the chart on the left, we look at the length of economic expansions versus the length of recessions. And you can see over time there that we basically spend 3 times longer in the average expansion than we do recession. We like to think of it as long summers, short winters. So we put a lot of mind share towards the amount of time we spend in recession, when in reality it's a lot less than what we spend in an expansion. Not only that, but let's think about the 2 recent recessions that we experienced and just acknowledge how severe those were. So what you can see in the chart on the right is essentially it's a timeline running across from about 100 years ago, various recessions that have occurred over time. And then as you move higher up in the slide, it corresponds to the length of the recession. So you can see there, Great Depression, the longest recession we've had in about 100 years. And then the bubble size corresponds to how much economic output was lost. So how severe was the recession itself? And you can see there that if we look at 2020 and we look at the pandemic recession, pretty large bubble. If we look right above that to the left, financial crisis, also pretty large bubble, longer recession than what we experienced during the pandemic. But if you look at all of these other recessions that occurred essentially from 1970 to about early 2000s, a lot of them were shorter in nature and milder in nature. And we think that the next recession we could experience is going to be a little bit more like that. Why? Well, there's two main reasons. The first reason is a lot of times before a recession, you see some sort of excess in the economy. You know, what we saw before the financial crisis was an excess of home building. What we had seen in the 90s was an excess of business capital spending. In the 70s, 80s, sometimes we would see an excess build in inventories or excess in car sales and car auto production. Right now, we're actually not seeing any major excesses in some of those cyclical areas of the economy that I mentioned. And they tend to amplify the natures of recessions. With some of those areas relatively subdued, that should lead to a milder recession. Another thing my boss likes to say, it's hard to get hurt falling out of a basement window. That's where we are with some of these things. So that should help insulate us and protect us. The other big factor that's likely to protect us in the next recession is the fact that the labor market is so tight. If you want a job in the US, you can probably get one. In fact, you might be able to get two. There are 2 job openings essentially for every 1 unemployed person. And what you can see on the chart here in that gray line is we look at the unemployment rate over time. Right now, the unemployment rate is at 3.7%. Now, we reached that type of unemployment rate just before the pandemic, but you'd have to go back to 1969 to see unemployment rates that low. So unemployment very, very low, essentially at a 50-year low. If we think about the supply of workers overall, I'm sure you've been to many stores, or maybe you're a business owner, maybe you know business owners, and everybody's biggest challenge is finding enough workers and the right workers. There is a structural labor shortage. What we have seen, even pre-pandemic, is that there was a kind of a remarkable resilience of people joining the labor force. A lot of those people were 55 and older. What we have seen since the pandemic is a lot of people in that group have retired. And it makes sense. If we think about the onset of COVID, it was absolutely awful from a health perspective. And yet, a lot of people's home prices went up. A lot of people's portfolio values recovered very quickly. So people had that wherewithal to retire and perhaps didn't want to take the health risk of going back to work. So we've seen that actually, when we think about people participating in the labor market, people from 25 to 55 almost mostly have come back. That participation rate is actually pretty close to what it was pre-COVID. The big difference in the labor market is that a lot of those people 55 plus have not come back and may not come back. We've also seen a decline over time in legal immigration, and that has changed the dynamics in terms of who we have as available workers. So we have a structural challenge here in terms of labor supply. It's positive because it means people have access to jobs, but it's also a double-edged sword because it means that businesses need to offer higher and higher wages in order to attract talent. So what you can see in the blue line there is if you look at this line here, it looks at wage growth today versus 1 year ago. And you can see that blue line there, the slope of the line kind of starting in 2011 is not that steep. But it got a lot steeper post-pandemic as a result of some of these labor supply challenges. So it's not a bad thing that people are earning more money, but what we also tend to see is that the worker is the consumer is the worker. So if you put more hands if you put more money into the hands of workers, that tends to go into consumption, and more demand within the economy tends to push up prices for a finite amount of goods. So there's, again, 2 sides to the labor market story. On the one hand, it is great that people have jobs, and it will insulate us during the next recession. We probably won't see the unemployment rate go as high as certainly it did during COVID, probably not as high as it did during the financial crisis. And potentially after that, people will be able to come back to the labor force and be hired more quickly than they were during prior recessions. So that is a good thing. The challenge is, as we continue to see wages grow faster and faster, that also tends to fuel inflation. So just to summarize, we don't think that we're in recession yet. We think we could be next year. We are seeing the economy slow. What will help us in the next recession is the fact that people have jobs and there's not a lot of cyclical excess. But the big challenge that we are dealing with today is 40-year high inflation. I probably don't need to tell you all that because everyone has probably experienced higher gas prices, higher grocery prices, higher prices when you are going out to dinner, higher prices when you're booking a vacation. And we're seeing that reflected in all areas of the economy. So what this chart here shows is the consumer price index. It is essentially a measure of all the different various prices throughout the economy. And then what you also see is the core consumer price index. So that excludes food and energy, which tend to be a little bit more volatile. So this is on a year-over-year basis. So we look at that increase in prices in the economy. You can see as of the most recent month, that overall measure climbed at 8.2% versus last year. That core measure climbed about 6.3% versus last year. You know, for the most part, if you take a look at this chart, over the last decade or 10 to 15 years, we were experiencing inflation at 2% maybe. So to be at 8% or 6% on that core measure is clearly a lot faster pace of increase in prices. So where do we go from here? I think that is the big question. Are we going to continue to see prices increase at this rate, or are we going to start to see prices gradually come down? Now, for us, we do feel that inflation has peaked, but it's going to take a long time to get back to that 2 or 3%. We might not be at that 2 to 3% increase level until late next year, and we may have to suffer a mild recession in order to get there. But we are seeing slowly but surely some improvements here. So we don't question the direction of travel, that inflation can come down. The challenge is the speed. How quickly can it come down? But we're seeing different measures at play here that lead us to believe that there is more signs of disinflation in the economy. So one thing we've seen roll over more recently is commodity prices. Now, this week aside, we started to see oil prices climb again. This is not a static or linear situation. We might see prices on commodities in fits and starts. They move down, they could go back up a little bit, they could come back down. Hence why we have core inflation, very volatile. But we had seen broadly across the economy, whether it's food or agricultural prices or energy prices or metals, they have come down since June. So still at higher levels, but increasing at a slower rate. So that should help over time bring down some of the measures of inflation. I mentioned the consumer. People have moved from goods to services. Eventually, people will lower their spending on both goods and services. That should help from a price perspective. Over the last 2 years, we've talked a lot about supply chain issues. You know, how long is it going to take me to get that couch I ordered 8 months ago? We're starting to see a lot of those pressures ease. Things are getting delivered faster. Prices are coming down. Shipping rates are coming down when we look across the economy. So that, which has been very inflationary, is starting to abate to some extent. The big challenge that we continue to face and will likely continue to face into next year is the fact that shelter costs are still high. We started to see some of the housing data roll over a little bit in the fact that mortgage rates are higher, so all of a sudden, and home prices are higher. You're not going to see what you saw in the middle of the pandemic when 10 people come in with an all-cash offer over ask to a house. We're seeing a lot less of that. So we're seeing that some of the home building, some of the home sales are starting to be reined in a little bit. Now, it takes a little bit longer for that to feed into the rental market, and in fact, a lot of people are turning to rental market instead while they're waiting for home prices and mortgage rates to settle down a bit. So that shelter component, which is about a third of the inflation index, will probably continue to rise before it starts to come down. And that's why, for all these reasons, it's going to take a little bit of time to get closer to a more moderate rate of inflation. And I also want to make the distinction here because some people might say, yeah, but prices are still high. There is that distinction between price level and price increases. So inflation looks at the rate of increase in prices, but to some extent, a lot of the prices across the economy and that price level has reset. So if something was $40 before the pandemic and now it's 60, it's probably not going back to 40, but equally it's probably not going to go jump to 80 as some of the rate of price increases slows. So what do we do about inflation? How do we solve the inflation challenge? You can see back in the 70s, 80s, how high inflation was, and it's starting to look a lot like that. So how do we avoid that outcome where we spend years and years with higher inflation? Well, we have to stamp it out, and the way we stamp it out is through higher interest rates. So what this slide here shows is the federal funds rate. It's essentially that benchmark policy rate that governs all interest rates in the economy. It sets a floor on mortgage rates. It sets a floor on how much we can borrow at for loans, how much companies can borrow at. And so you can see this federal funds rate that's set by the Federal Reserve, our central bank, over time. Now, the Federal Reserve pays attention to two things. They pay attention to employment because they want to be fostering an environment where there's maximum employment. We are at that point. But they also want to pay attention to price stability. And clearly, based on the last slide, we are not in an environment of price stability. So in order to bring us into an environment of price stability, they raise rates. And so we started the year at 0, and in the last 6 months, we've essentially gone from 0 to between 3 and 3.25. So that's a really fast rise in rates. And just compare it to that step function up between 2015 and 2018. We saw a pretty gradual raising of rates, and it happened over the course of 3 years. This is like 6 months, so you can see that line go straight up. What we can also see on this slide in blue and in green is measures of expectations of where this rate goes. So blue looks at where the Fed thinks this rate will go. Green looks at where the market thinks this rate will go. What you can see is there's not necessarily a tight alignment here. There's been a lot of uncertainty about where rates should go and where they will end. And a lot of that is going to depend on how we continue to see inflation and wage and jobs data come in. So we don't know what the ceiling is on the federal funds rate yet, but we do know that we're not quite there yet. And we also know that rates have gone up very quickly. So the Fed is working aggressively to get rid of inflation once and for all. It may entail an economic recession in order to get there, but their primary goal is getting that prices under control. Now, of course, as the Fed has shifted the goalposts throughout the year about how much they're going to raise rates, because remember, at this time last year, the Fed said we might not need to raise rates at all in 2022. Obviously, that has been very different when we take a look at this chart here. And that has had a really dramatic impact on our portfolios. So just to show you how much rates have increased across the economy this year, what this chart shows is you look at different yields on different treasury bonds. So you look at a 2-year treasury bond, what yield are you getting, 10-year, 20-year, 30-year. And if you look at as of December 31st of this year, the 10-year treasury yield, for example, was at 1.5%. Today, it is north of 3.5%, well north. And in fact, last week even touched 4%. These are not normal moves that you would experience in a given year. These are very extraordinary moves and pretty astounding when we think about what changes we've experienced this year. Now, on the one hand, this should help to control inflation. On the other hand, as investors, if you hold a bond, as those yields go up, your bond prices go down. So many people have probably experienced in their portfolios a pretty challenging year in the bond market. Now, it's also, of course, been a challenging year in the equity market as well. So what this slide shows is the S&P 500's calendar year returns back since 1980, and then also the maximum the market fell in a given year in those red dots. So on average, the market falls about 14% each year. This year, at our worst, we fell down about 25%. We're down about 20% right now. So you can see more than usual volatility, because rates are that common factor between how you value a bond and how you value a stock. And the higher that rate, the higher that hurdle rate. So that makes it a more challenging environment from a stock and bond perspective. But what we have seen over time is that for investors who have suffered the sell-off in the equity market, eventually they're often rewarded with a rebound. Now, it might take some time, but what we have seen over time is that the stock market has ended up on a calendar year basis positive in 32 out of the last 42 years. Now, given where we are today, I would not necessarily expect that for the end of this year, but remember that calendar years are somewhat arbitrary. It is, when we get our statements, when the year ends, but it doesn't necessarily dictate anything about the market or economic cycle. We're probably going to see a bit more volatility as we think about the rest of the year. There's still a lot of uncertainty about the Fed and inflation and economic growth. So we need to get more information and more clarity around some of those items. But we have typically seen over the course of history that the S&P 500 has never failed to regain a prior peak and then surpass it. So we want to be a bit patient here. Because I think what is misunderstood about volatility is that volatility is a feature, not a flaw of the markets. It actually does create some opportunity for investors, but it's not the portfolio killer. The portfolio killer is what we do during times of volatility, because this is the time when people tend to lose their head and want to try to time the market, want to try to get out, come back in. And what we typically see is these types of investor behaviors over the long run tend to make it harder to achieve your eventual investment goal. What we have tended to see is that these are the instances where when you get to that retirement age or ready to buy a house, you might face shortfall risk because you weren't invested long enough to grow your money during the expansionary times because you were so focused on trying to preserve capital during the recessionary times. But again, we know that volatility is coming. We don't know when, we don't know why, but we know at some point it will, and that is why we diversify portfolios so that we're not putting all of our eggs in one basket for times like these. Again, the reason we have investment plans are for times like these when things are uncertain and falling apart, not for the boom times when everything is going just fine. These times are when we want to have a roadmap when we don't know what's coming next. I'd also say these are times where, again, people kind of lose their head a little bit about what's going on in the market, but how you feel about the economy tends to be a poor guide for how you should invest. So what this slide here shows is consumer sentiment over time. And you can see where we are today. We've come off a little bit off of the lows here, but we were essentially at all-time lows. So consumer sentiment was the worst in June that it has been since this data started to be measured back in 1970. So worse than August 2011 when US debt got downgraded and there was the sovereign debt crisis over in Europe. Worse than the financial crisis, worse than COVID, than 9/11, than all of these different points in history when people felt really bad. And yet, when you overlay investment returns with sentiment, it shows a very different picture. And that's often why people say investor sentiment is sort of a contrarian indicator of where we go next in the markets. Because what we've mapped out in those blue dots on top is the market, is the sentiment peaks when people felt the best about the economic environment. And if you looked at the S&P 500 and put $100 in every time we had one of those peaks, on average, your return 1 year later would have been about 4%. But if you invested when we were at the absolute bottoms in sentiment, when people felt their worst, your 1 year later return on average across those 8 troughs in sentiment would have been about 25%. So that's not to say we're going straight up 25% from here. We still want to be cautious and mindful in terms of how we're investing given a lot of the uncertainty. But it does go to show that this is the exact wrong time to give up. It also goes to show that when we think about investing, very simply, buy low and sell high, and yet we feel the exact opposite when it's the right time to do those things. So something important to keep in mind. One of the benefits maybe of this environment, if we're looking for a silver lining here, is if we think about where we've been, we had really challenging returns, not only in stocks, but also in bonds. But if we think about where we get to go from here, when you see valuations on stocks and bonds reset, it often sets us up better for longer term returns. So for example, what you can see on this slide here is the S&P 500's forward price to earnings ratio, essentially a measure of how cheap or expensive stocks are. And you can see we're well below our sort of longer term average here at about 15.5 times forward earnings. So are we closer to the bottom? Are we closer to the top? Well, if you take a look at where we were in March 2020, we were at about 14x. If you take a look at where we were when we were recovering from COVID, it was above 22x. So we are closer to the bottom than we are the top. Are we at the bottom? Probably not. But does it matter that we invest at the absolute bottom? Typically no, because when we have valuations around these levels, they tend to not really do much for us over the next couple of weeks or months, but on a multi-year time horizon, tend to potentially offer pretty attractive returns. So what I mean by that in kind of a practical example, earlier I mentioned that the S&P 500 has never failed to regain a prior peak and then surpass it. Let's assume that that happens again at some point. So we had our peak in the S&P 500 on January 3rd of this year. What kind of returns would we be looking at on the way back up if we were to, again, achieve that peak again? Now, a lot of uncertainty in the near term. Let's say that doesn't happen in the next year. Let's say that doesn't even happen in the next 2 years. Let's say it takes 3 years for us to get back to that peak. The implied return on an annualized basis you'd be looking at to get back to that peak would be about 11%. So we could potentially be in for some period of time of double-digit returns over the next couple of years if we think about where valuations have reset to and where the market has reset to. So potentially attractive returns on a longer-term basis. We still need to be cautious in the ensuing months and weeks. Now, again, how do we operate in this type of environment? What are some of the strategies to smooth out that volatility over time? Well, what we tend to see is when markets are interesting and markets are volatile, we want to be steady, we want to be stable, we want to be a little bit boring. And that means some of the longer-term time-tested strategies, like being diversified, like having that longer-term time horizon to take advantage of valuations at these levels on a multi-year basis. So what you can see on this chart here is a range of stock, bond, and 50-50 portfolio returns. So stock in green, bond in blue, gray is a mix of both. We look at calendar year returns back since 1950, and we look on a 1, 5, 10, and 20-year rolling basis. So for example, on the 1-year basis, you could have been invested in the stock market any one given year back since 1950 and had a 47% return. You also could have had a negative 39% return. So huge range of outcomes that are really challenging for planning purposes. But if you add a little bit of bonds to that allocation and you look at those 50-50 portfolios, the range of outcomes condenses. If you look over longer time horizons, not only does that range of outcomes condense pretty significantly, but it also overwhelmingly skews positive over the long run. And you don't have, in this example, a period of negative returns over the rolling 5, 10, or 20 years. So that is the power of having that longer term outlook, of having that diversification in portfolios to help combat volatility in the long run. Now, I do want to note that this has been an exceptional year, meaning that typically what we see is that when stocks start to do poorly, bonds protect. And the exception this year is that bonds have not protected. They've done poorly because we've had this inflation shock in which rates need to move higher in order to tame inflation. And that has been very challenging for bond returns. Again, rates go up, bond prices go down. So we've really suffered on both ends of the portfolio this year. But it is, again, to the point of the consumer confidence slide, the exact wrong time to abandon some of the strategies that have worked over time. So this looks at the 60-40 portfolio. It looks very similar to that equity slide from a few slides back, but it looks at a 60-40 diversified portfolio where we look at 60% equities, 40% bonds, and we look at how those components have performed in green for equities and in gray for fixed income back since 1980. And we also look at those intra-year declines. What you tend to see is, on average, the 60-40 falls nearly 8%, but ended up positive in 35 out of the last 42 years. Now, part of that is, again, stocks and bonds kind of working together, one working when the other doesn't. But if we look back just over the last 10, 15 years coming out of the financial crisis, we've had an average of about 11% annualized returns on a 60-40 portfolio. So it has worked exceptionally well, but it's not going to work well every single year. And this is one of the years where we're experiencing more challenges because of the inflation and rates environment. So you can see that we've sold off double digits this year. Now, this is not entirely unprecedented. Over the course of this time period, we have seen double-digit declines in that 60-40 portfolio about 9 times. And in 8 out of those 9 times, the following calendar year return ended up positive to an average of about 17%. So again, not guaranteeing those types of returns imminently. We still have a lot of uncertainty ahead of us, but we have seen that diversification does work over time. And in a year where returns have come down so much and therefore valuations have reset so much, now we have on both the stock and bond side, from a go-forward basis, more attractive longer-term valuations, which should help from a potential return perspective. So overall, what do we do with portfolios in this environment? Above all, we want to be disciplined. Again, we have an investment plan, we have a roadmap that takes into account environments that are like this. I'd also say this is sort of a back to the basics environment where we care about how cheap or expensive stocks or bonds are, where we care about how good are company balance sheets, where we care about how good are company management, what's their long-term plan. In an environment where wages are rising, where input costs are rising, how are they able to tackle some of these issues? So we really look at things on a company-by-company basis, both on the stock side and on the bond side, to look for areas of strength. You could have been invested in pretty much any area of the equity market last year and done well, and patted yourself on the back because everything went up and it felt like, okay, this is a great environment. But in years like this, that's when we really can distinguish ourselves and be active and thoughtful in how we're thinking about companies on both sides of the balance sheet in order to look for the best opportunities for longer term returns. So this is an environment of greater differentiation. It's not that there are no opportunities because the stock market overall has gone down or the bond market overall has gone down. That's not the case for every single company. So we do look for, again, some of those quality companies that we want to own for the long run. But again, sticking to that investment plan, having that investment discipline in this type of environment, over time has shown to be a good strategy to weather environments like this. So maybe I'll pause there and happy to open it up to any questions. Sure.
Just one statement. Some of our online viewers have asked any questions that are made. You can repeat them first.
Sure.
They're not hearing them that well.
Sure. Sure.
For the JP Morgan model, is there some real-world event or government policy that could affect your model looking forward?
So the question.
One thing you haven't talked about is the root cause necessarily of inflation. You talk about it, but somewhere along the line something happened to cause it.
Yep. So question was on the root cause of inflation. How did we get here? How did we get to the point of having 8-9% inflation? And how does that factor into how we think about investing? So if we think about what caused inflation, it's a couple of different things. Let's think about it in terms of supply and demand. So on the supply side, we had a cutoff in supply in certain areas. So we had a major change to our supply in energy globally when we think about the war between Russia and Ukraine. Same thing with food. We get a lot of fertilizers, we get a lot of wheat, we get a lot of agricultural products between Russia and Ukraine. So that caused a difference from a supply perspective. We also had an environment where many areas of the world shut down because of COVID, including areas that are major pieces of, major nodes within manufacturing. So that meant supply chains themselves got disrupted, and that meant less supply coming to a lot of demand. On the demand side, we saw essentially, trillions of dollars spent by the government from a fiscal support perspective in order to support the economy. And that meant that a lot of people had a lot more money to spend, and in a time where the economy was essentially shut down. So when the economy started to open up, you saw a lot of spending. I talked about consumer patterns, and last year, kind of the buy everything, people had that wherewithal. Even right now, consumers have about $1 trillion on the sidelines in excess savings, more than we typically do. So the consumer had a lot of firepower given some of the fiscal policies implemented over the last 2 years. So how do we think about some of that going forward? The geopolitical situation is really challenging. I won't pretend to be an expert on Russia. I won't pretend to be an expert on China. These are things that we do think about and we do monitor. We were talking about this in the last session with some of the geopolitical risks. Historically, in the recent past. A lot of them haven't necessarily had as big of an impact in terms of markets and economics, typically, but one of the reasons why this one did is because we were already in an environment where energy prices had started to rise, food prices had started to rise, so of course this supply challenge had made things even worse in an environment where inflation was already high. Now when we think about the fiscal side, and how do we think about the fiscal picture and our government spending play out in the long run? You know, one of the things we didn't see a lot after the financial crisis was fiscal spending. We saw a lot of monetary policy. We saw the Fed cut rates to zero. We saw the Fed expand its balance sheet, but we didn't see a lot of fiscal spending. This time around, we saw multiple $1 trillion of fiscal spending, and that has been a big change versus what we had seen after the prior recession. So where do we go from here? Because we are sitting on a sizable mountain of debt. So our debt to GDP went from about 80% pre-COVID to about 100%. So in the long run, we're going to have to pay for it. It's going to take generations probably to get our debt to a reasonable place through probably a mix of spending cuts and tax increases. But when we think about the sustainability of this debt, rates have risen, which makes paying for this debt more expensive over time. Not all at once, but over time, it will become more expensive to make these interest payments. So from a longer term perspective, we don't think that the US is going to default on its debt, but it is going to mean more money going into interest payments is going to be a structural drag on growth because that money could be going to other areas that are increasing productivity or helping out, add more workers. So it will be a drag on growth, and it will likely be something that structurally supports inflation. So do I think that we could get inflation by the end of next year closer to the Fed's 2% target? I think so. But is it going to stay at that 2%? I think a lot has changed post-pandemic, and when we think about the impact of some of the fiscal spending in the long run, that's probably going to mean we are closer to something like 3% inflation in normal times. So we spent the last 10 to 15 years not being able to get to 2%. We didn't talk about inflation at all during our presentations over the last 10 or 15 years because it simply wasn't present. We couldn't get to that 2%. I think over the next 10 to 15 years, we're not going to be able to get down to that 2% and stay there. We'll probably be closer to 3%. So I do think when we think about the causes of inflation, there have been structural changes to some of our supply when it comes to energy and food, to some of our fiscal spending as well that will continue to push upward pressure on inflation. Even if we're able to get it to a more sustainable place, it's not going to be the subdued lack of inflation that we saw over the last 10 to 15 years. Yes?
Our energy situation in this country is not entirely explained by the war. Our government actively attacked energy in this country, and inflation was beginning before the war.
So the question is about our energy policies within the United States and how the energy supply is impacted domestically. And I think that's a valid point. I mean, as I mentioned, one of the things that has made the Russia-Ukraine situation so challenging from an energy perspective is that energy prices were already on the rise. So if we think back to, call it 10 years back, have the shale revolution, we have massive amounts of supply of oil within the United States. What we then started to see is that from 2014 to 2016, oil prices came down pretty significantly. Part of that was policy. Part of that was the fact that with a lot of these different companies adding leverage to their balance sheets, spending, a lot of investors didn't necessarily like that. What has become the trendy thing to say within a lot of these energy companies is capital discipline, really reining in on some of that spending. But when you rein in on that spending, it means you're doing less long-term investing. So a lot of the supply that we had, you see producers go out of business. You see producers consolidating into one business. You can't necessarily turn the taps off and then expect to be able to turn them back on because it does require a lot of subsequent investment in order to keep things going. So while we have, underneath the ground a lot of supply, we don't necessarily have the infrastructure. If we think about refining capacity, we are basically at capacity, and that's not enough to kind of feed a lot of the supply that we need. So we tend to see different boom and bust cycles within the energy space. There has been less of an investment, an underinvestment in the last 5 to 7 years that we've seen over time. And we have seen different government policies that have restricted some of the exploration and drilling in different places. So, this is, again, a structural challenge that we see in terms of we do technically have the supply, but to get to use that supply, it can take a few years to really get that up and running. So again, when I think about tying it back to the previous question about structural inflation, that is going to be a challenge from an energy supply perspective as well, whether it's global and some of the challenges overseas in terms of supply, or domestically in terms of supporting some of the supply that we naturally have.